Welcome to The Explainer. Today we're diving into an analysis that makes a pretty staggering claim that we are living through the biggest financial bubble in all of history. And if it's right, it's about to change everything for investors. So, the whole analysis kicks off with this huge question. It argues that if you look around at stocks, at real estate, you name it, asset prices have been pushed to levels we have just never seen before. It's a bold place to start, so okay, let's get into it. All right, so to really wrap our heads around this argument, we first need to be on the same page. What even is a financial bubble? The analysis we're looking at here gives us a classic definition to work with. Okay, so the magic ingredient, the absolute key here, is credit. Bubbles aren't just about high prices. They're about high prices being fueled by a frenzy of borrowed money until things get totally detached from reality. So with that in mind, let's see what evidence the source puts on the table for today, starting with the stock market. According to this analysis, if you just measure the total value of the U.S. stock market against the size of the entire U.S. economy, stocks have literally never been this expensive. And this chart really puts it in perspective. We're not just a little bit higher than the peak before the 1929 crash or the dot-com mania in 2000. We're in a completely different stratosphere. And it's not just a stock market story. The analysis is quick to point out that the other huge asset for most people, their house, is in the same boat. In the U.S., once you adjust for inflation, real estate prices have now blown past their 2006 peak, the peak that happened right before the entire global financial system almost came crashing down. So we've got stocks and real estate, both at record highs. But remember that definition we started with? A real bubble is fueled by credit. So the obvious next question is, what does the credit situation actually look like? Well, according to this analysis, it's the very heart of the entire situation. The engine driving all of this, the source argues, is just a historic mountain of debt. I mean, look at this number. Globally, total debt is now more than 2.5 times the size of the entire world's annual economic output. It's an all-time record. And this slide really pinpoints what the analysis sees as the moment everything changed. For decades, global debt was kind of stable. It stayed in a predictable range. But the source links this massive explosion in debt directly to 1971. That's the year the US dollar was taken off the gold standard. The argument is that this move basically took the brakes off the money creation machine, allowing credit to be created on a scale that was just unimaginable before. So you end up with this record amount of debt, a level that the source argues just can't be paid back through normal means. And that creates a massive dilemma. It leads to a pretty stark choice with only two ways out. The analysis basically says you have two doors. Behind door number one is a catastrophic collapse, a 1930s-style depression where everything defaults. Not a great option. So policymakers will almost certainly pick door number two, a sustained period of inflation. See, by devaluing the money itself, they make all that debt much easier to handle. But that's not a free lunch. Someone has to pay for it. And that someone is anyone who has cash savings. And this is really the sharpest point in the entire argument. Inflation is a wealth transfer, plain and simple. When your savings can buy 10% less than they could last year, that value didn't just vanish into thin air. It was effectively transferred from you, the saver, to the biggest debtors, especially governments. Now, the source uses this really fantastic analogy. It compares all our collective savings sitting in bank accounts to a giant reservoir of water held back by a dam. Right now, that reservoir has never been fuller. But what happens if people start to lose faith in the dam, in the value of their money? They all rush to pull their water out at once, to spend it on real stuff. That flood of money, chasing the same amount of goods, is what can turn moderate inflation into a tidal wave. So if we follow this logic and sustained inflation is the most likely path forward, what in the world does that mean for your money? Well, this is where the rubber really meets the road, because the analysis suggests that the investment playbook that has worked for the last 40 years is about to be completely useless. So first, let's talk about what gets hurt. The strategies that have worked for decades, like buying stocks and bonds, tend to get crushed in a high inflation world. The source points right to the 1970s, a period where the S&P 500 lost about 40% of its real value. And it's interesting, even newer things like Bitcoin are flagged here as a speculative game token that might not survive a real crisis. So if that's what doesn't work, what does? Well, historically, the big winners have been real assets, actual physical stuff. This table lays it all out.
Things like commodities, gold, and the companies that dig this stuff out of the ground have historically delivered positive returns, even after you account for inflation. Meanwhile, stocks and bonds have actually lost you money in real terms.
And here's a fascinating little detail the analysis zooms in on. It claims that unlike past market tops, the current run-up in assets like gold isn't being driven by a frenzy of everyday investors. The argument is that the big players are quietly making their move, but the general public is still sitting on the sidelines. The source interprets this as a sign that we could still be in the very early innings of this whole shift. And that leaves us with this final, massive question. The source is essentially challenging us to wonder if the entire investment landscape that we've known since the 1980s is about to be turned completely on its head. It forces us to ask, are we about to witness a great reversal where the winners of the past become the losers of the future?